Hello everyone, welcome back to my channel. Today, I've got something absolutely exciting to share with you. The 3 major trends sweeping across the Chinese stock market that could dramatically transform your investment strategy. Whether you're a beginner just starting out or an experienced investor looking for that extra edge, this video is for you. So make sure you hit that like button right now and subscribe if you want more valuable investing insights and easy to understand financial tips. I guarantee you'll walk away from this video with actionable steps that you can start using immediately. Let's dive right in. The rise of institutionalization. Let's talk about the first big trend, institutionalization of the Chinese stock market. If you go back around 10 years, the market was dominated by retail investors, everyday folks hoping to make a quick buck. This led to a lot of volatility and speculation. Prices would swing wildly based on rumors, news, or hype. It was like the Wild West out there, with smaller retail traders as the main driving force. But fast forward to today, and we're seeing a major shift. Domestic institutions like pension funds, insurance companies, and mutual funds, and even foreign institutions are getting into the market in a big way. Their presence has grown significantly, and they are rapidly becoming a dominating force. As a result, retail investors no longer account for the lion's share of daily trading volume. And here's a fascinating twist. Even the retail investors that remain are increasingly choosing to buy ETFs or more passive products, rather than attempting to beat the market by actively picking stocks. You might be thinking, okay, so how does this trend help me make money? Well, institutional investors generally play a stabilizing role in the market. They do detailed research, follow long-term strategies, and are less prone to panic selling at every bump in the road. For individual investors like you and me, this means the market will, over time, become less chaotic. And that's good news if you're investing with a longer horizon. It's also important to note the existence of the so-called national team, basically government-backed funds, that can step in to buy shares if the market slumps too much, helping keep valuations a bit more stable. Actionable tip. In an environment dominated by institutional money, it can be tough for small investors to beat the professionals at their own game. Focus on high-quality companies or broad-based ETFs that track major market indexes. Don't get caught chasing the hottest stock rumor you found online. When the big players move, they move with precision and research. The power of indexation. All right, now let's move on to the second massive trend. Indexation. This is all about the rapid growth of ETFs and passive investment funds in China. Just a few years ago, active managers and stock pickers ruled the roost. Everyone wanted to find the next big winner, the next unicorn, or the next company that would quadruple in value overnight. But these days, more and more people are realizing that indexing tracking a basket of stocks, rather than trying to guess which single stock will outperform, is a powerful and cost-effective strategy. The popularity of index-based investing has soared so high that by the end of 2024, the size of passive investments in the Chinese mutual fund industry exceeded active investments for the first time in history. That is a huge milestone. This trend ties right in with the institutionalization we just talked about. As large institutions increasingly turn to index funds and ETFs, these products receive more money, and that money systematically goes into the largest stocks in the index. What does this mean for individual investors? Well, when money flows into index tracking funds, the stocks included in those indexes benefit disproportionately. Typically, these are big cap stocks. Meanwhile, small caps might get squeezed because there isn't as much active capital scouting for hidden gems. Actionable tip. If you're looking for a straightforward strategy, consider broad-based index ETFs, like those tracking the CSI 300 or other well-known Chinese benchmarks. Over the long run, if the market grows, the major index constituents stand to gain the most. This strategy can be especially beneficial for folks who lack the time to do in-depth research on individual companies. Plus, index ETFs usually come with lower fees compared to actively managed funds. If you want to dip your toes into the Chinese market but aren't sure where to start, a broad-based ETF is a great option to explore. The wave of quantification. Moving on to the third big trend, quantification. As technology advances, the proportion of quantitative trading based on complex computer algorithms and high-frequency data analysis is exploding in the Chinese stock market. Quant funds use mathematical models, statistical techniques, and sometimes even artificial intelligence to gain an edge in the market. Because quant strategies rely on processing massive amounts of data much faster than any human could, they can often spot tiny mispricing and trade them away in a matter of milliseconds. So, what does that mean for someone like you who might be sitting at home or on the go, trying to do some part-time trading? If you're attempting short-term, high-frequency trades, you're competing against lightning-fast computers. That can be an uphill battle, like racing a supercar on foot. This is one of the reasons many retail traders find it harder and harder to succeed at day trading or short-term speculation. But let's not be discouraged. There are opportunities if you play your cards right. Retail investors who take a longer time horizon, focus on fundamental analysis, and hold on to well-researched positions may sidestep the biggest dangers of going head-to-head with the quants in the short-term game. Actionable tip: if you're drawn to trading, try to add a quant-like perspective to your decision-making. For instance, you can use basic technical indicators like moving averages or momentum signals to better time your entries and exits, but don't rely on them exclusively. Also, be realistic. If you're a part-time trader, it's challenging to compete with full-scale quant operations in short-term trading. A more consistent approach might be combining simple quantitative filters, like screening for fundamental strength, low valuation, and steady earnings growth, to identify potential winners you can hold for a while. Putting it all together, how you can profit. So how can you put all these pieces together to make money in the Chinese stock market? Well, my personal favorite strategy is a mixture of long-term index investing and selective stock picking. Let's break it down. First, Index Core Portfolio. Allocate a substantial portion of your China exposure to a broad-based index ETF. This immediately diversifies you across many big-cap stocks that stand to benefit from the structural flow of capital from institutions and passive investors. Second, tactical opportunities. If you have the desire and time to do research, consider adding a few individual stocks that you believe are strong leaders in their sectors. But always keep in mind the increasing power of quant funds and the stabilizing effect of large institutions. 3. Risk management. The national team might step in during drastic market drops, but don't rely on that as a guaranteed safety net. Maintain some form of risk management strategy. This could be anything from simple stop-loss orders to more sophisticated hedging techniques, depending on your knowledge and risk tolerance. 4. Continuous learning. The Chinese market is incredibly dynamic. Regulations can change quickly, industries can gain or lose favor overnight, and global sentiment can swing widely. Keep learning and stay current with market trends, policy shifts, and technological developments. Real-life example: Alibaba and the ETF effect. Let's bring this to life with a real-world example. Consider Alibaba, which is often included in major Chinese and global indexes. Whenever huge sums flow into those index funds, it automatically buys more shares of companies like Alibaba. Even if there's no immediate fundamental news driving Alibaba's stock, the weight of passive inflows can push the stock price up. This is the power of index investing in action, where big companies get bigger just because of their dominant position in the index. Now, if you also happen to personally believe in Alibaba's growth story, adding some shares could offer a double benefit: the natural inflow from index funds, plus your own conviction in the company's fundamentals. A quick note on psychology. Remember that investing isn't just about picking the right strategy, it's about sticking with it. If you constantly chase the hottest trends, jump in and out of positions, or get swayed by fear when the market dips, you'll likely get poor results. Consistency and discipline, especially in a market that's undergoing significant changes, can be your greatest allies. As individual investors, we sometimes feel overwhelmed by institutional power and quant strategies. But the upside is that these trends can stabilize markets and offer great long-term opportunities if you're investing with a patient approach. Focus on your own goals, your risk tolerance, and the strategies we talked about in this video. Conclusion: your path forward. To sum it all up, institutionalization, indexation, and quantification are reshaping the Chinese stock market in ways that present both challenges and opportunities for retail investors. By focusing on broad-based ETFs, staying mindful of the macro shifts, and resisting the urge to jump into short-term trades against lightning-fast quant funds, you could put yourself on a path to potentially better and more consistent returns. If you found value in this video, please do me a favor, give this video a like and hit the subscribe button right now. It lets me know that you enjoy this type of content and want more. Plus, it'll help more people discover these investing insights and join our community. Don't forget to share your thoughts in the comments. Do you prefer actively managed funds, or do you like the simplicity of passive index ETFs? Let's chat down below. This video is for entertainment purpose only. Please consult licensed advisor before making real investments.